Welcome to TalkTickers, your deep dive into the latest earnings calls. Today, we're unpacking InMode's first quarter 2025 earnings call.
Yeah, and what really jumps out right away is, well, a company clearly dealing with some pretty big macroeconomic headwinds.
Definitely. You can see it hitting the medical aesthetic market hard, impacting, both revenue and profitability.
That's right. The main story here is this noticeable slowdown in elective procedures. We're talking especially the surgical aesthetic side.
And it's not just a blip, is it? It feels like a more persistent trend.
Exactly, driven by, well, ongoing economic uncertainty and, frankly, consumers just being a lot more cautious with their spending.
So let's look at the numbers real quick. Q1 2025 total revenue, $77.9 million. That's down 3% year over year.
Mm-hmm. And gross margins saw a bit of a squeeze, too.
Right. But like you said, the numbers only tell part of it. What's really interesting, I think, is how management's responding to all this.
Absolutely. We should definitely dig into the financials, but maybe more importantly, look at their strategic choices, like around their workforce and investments.
Yeah, and their updated guidance. It kind of reflects both the ongoing pressure, but also maybe some cautious optimism, or perhaps just sticking to their guns.
Cautious, maybe even defiant optimism. Yeah.
Yeah.
We'll get into the geographic shifts, too, which are quite surprising, utilization trends, and even the impact of U.S. tariffs. Kind of unexpected.
Okay, so setting the scene a bit more. This medical aesthetic market, as you said, it's feeling the pinch. Macro uncertainty, soft consumer demand, as InMode put it.
It makes sense, right? When money gets tight for households, those bigger ticket elective procedures, especially surgical ones, they're often the first things people decide to put off.
It's a pattern we've seen building.
Oh, yeah, over the last couple of years. Patients are delaying expensive treatments. But it's not just patients. Doctors, the providers, they're also being much more careful about buying new equipment.
Right, the capital investment side.
Exactly. And this slowdown really picked up steam, you remember, mid-2023. That's when interest rates and inflation in the U.S. really started climbing.
Yeah.
Think of the leasing companies. That's how most doctors finance this kind of equipment.
Yeah.
Their typical interest rates, maybe 6-7% before, suddenly jumped to like 14-15%.
Wow. That's huge.
It basically just throttles capital equipment purchases right there.
So it's kind of a double whammy then. High interest costs for the doctors trying to buy equipment and consumers feeling less confident about spending on the procedures themselves.
Precisely.
You mentioned provider caution, but is there specific data from this quarter showing that drop in patient confidence, or is it more inferred?
Oh, no, the data points pretty directly to a consumer pullback. I mean, think about the cost. A minimally invasive RFAL procedure that's radiofrequency assisted liposuction, it can run you $4,000 or $5,000.
Okay, yeah, not pocket change.
Right. So when consumer confidence dipped last year, people just started postponing. And we see it really clearly in their disposable usage numbers this quarter.
How so? What did those show?
Well, in Q1, they sold about 237,000 disposables, which, okay, sounds comparable to Q1 2023.
Okay.
But, and this is the key part, InMode has put almost 9,000 new systems out there globally in the last 2 years.
Ah, right. So the installed base is much bigger.
Exactly. So even with way more machines out there, the average use per doctor for these minimally invasive treatments anyway, it's actually down about 30%.
30%, that's a massive drop in utilization.
It's profound. It tells you that even their existing customers are seeing much less demand. So these headwinds aren't just about selling new machines, they're hitting the core activity of their installed base.
That 30% figure really stands out. And what's maybe even more striking is management's reaction, or lack of reaction in some ways.
You mean sticking to their strategy?
Yeah, they've explicitly decided not to cut staff or, slash costs in response to this. They keep saying they want to lead the industry and be ready for the rebound.
It's a long-term play, for sure. They even pointed out that Q1 this year was worse than Q1 last year, and last year had the disruption from the war in Israel. So things aren't getting better yet.
Right. They basically said there's no light at the end of the tunnel visible right now for this slowdown.
And that commitment, that long-term view, it extends to R&D too. They're planning to launch a new platform later this year aimed at the wellness market, trying to diversify.
Even with the current market being so tough.
Yeah, despite it. They also admitted that some newer products, like Ignite and Optimus Max from last year, haven't really gained the usual traction because, well, the whole market's down.
It really is that classic tension, isn't it? Short-term profitability versus investing for the long haul.
Absolutely.
So, okay, with that context market under pressure, management holding firm, How did this actually play out in the Q1 financials? Let's unpack those numbers.
Right. So top line, as you said, $77.9 million total revenue. That's the 3% year-over-year dip we mentioned, a clear sign of the slowdown.
And that pressure flowed down to margins.
It did. GAAP gross margin came in at 78%, down from 80% in Q1 2024. Non-GAAP was similar, 79%, down from 81%.
Okay. At operating expenses.
GAAP operating expenses actually went down slightly, 1% year over year, to $45.3 million. But interestingly, non-GAAP operating expenses went up 2% to $43.1 million.
So what does that tell us?
Well, taken together, it really paints a picture of declining operational efficiency. Even with GAAP expenses slightly down, the non-GAAP ones ticked up. And that squeezed non-GAAP operating margin significantly from 27% down to 23%.
So they're feeling the pinch not just on sales, but converting those sales to profit is getting harder.
Exactly. Profitability definitely took a hit. GAAP diluted EPS was 26 cents down from 28 cents. Non-GAAP was $1.31, down just slightly from $1.32 last year.
But the balance sheet still looks okay.
Yeah, the balance sheet is strong. They ended the quarter with $512.9 million in cash and equivalents, and they still generated $14 million from operations. So, yeah, income statement's struggling, but the foundation looks solid.
Okay. Now, the guidance. This seems like the really big news from the call.
Definitely the most telling part. They're keeping the full-year revenue guidance for 2025 at $395 million to $405 million range.
But they admitted that's pretty optimistic, right? Contingent on a big Q2 bounce back.
Very optimistic. They basically said Q2 needs to be strong. Usually it's like 25% or more of their annual revenue. If Q2 doesn't top $100 million, they'll likely have to cut that full-year revenue target. So, yeah, it's a bit of a gamble.
Okay, holding revenue guidance, but what about profitability?
That's where the major cuts came. Non-GAAP gross margins are now expected to be 78% to 80%, down from 80% to 82% before.
Okay, a couple of points there.
But the big one is non-GAAP operating income. They slashed that forecast. It's now projected between $101 million and $106 million.
Whoa, what was it before?
Previously, it was $130 million to $135 million. So a really sharp drop.
That's huge. And that impacts EPS guidance too, presumably.
Directly. Non-GAAP EPS is now expected between $1.64 and $1.68. That's down from the previous $1.95 to $1.99 range. It's a major reset of expectations for the year's profitability.
Wow. Holding revenue but slashing profit forecasts that much really tells a story about the cost pressures and maybe the sales mix.
Exactly. And a key factor there, something that really stood out, is the geographic shift you mentioned earlier.
Right, the U.S. market weakness.
Yeah. The U.S. used to be, 63% of their total revenue back in 2023, 2024. This quarter, it dropped to almost bang on 50%. The decline in the U.S. was way worse than other regions.
And international picked up the slack.
Relatively speaking.
Yeah.
International sales were $38 million. That's 49% of the total, actually up 1% year over year. And Europe, specifically, had record sales.
Record sales in Europe amidst this. That's quite the contrast.
It really is. And this shift, more international sales, less U.S., is expected to drag down operating margins by about 4 or 5% just because of the sales mix differences.
Okay, that explains some of the margin pressure. And then there were the tariffs.
Right, the U.S. tariffs. They clarified the current 10% tariff is probably hitting gross margins by about 2-3%.
And they're absorbing that cost, not passing it on.
Yeah, they made a point of saying they're not passing it on to customers. Which, makes sense in a market where doctors are already facing those super high leasing rates. They only raise prices, they said, when they introduce new upgraded products.
So that 2-3% hit from tariffs is baked into the new lower gross margin guidance.
Correct. It's already factored in. It shows, again, that commitment to holding market share, even if it hurts the bottom line short term.
And that kind of strategic thinking seems to tie into what they said about capital allocation too, right? Especially share buybacks.
Oh, yeah, that was another really interesting piece. They've spent over $500 million, $500 million on share repurchases. Average price was $19.95 per share.
And the stock is currently
around $15. So they basically acknowledged, quite frankly, that the buybacks haven't delivered the return they hoped for.
Ouch. So what are they doing now?
They're pausing further share repurchases for the time being. It's a pretty stark admission, really.
It signals a big shift, doesn't it? Okay, maybe propping up the stock isn't the best use of cash right now.
It feels like a forced pivot. They're clearly signaling they need that cash for other things, maybe looking outside the company for growth instead of just betting on their own stock price going up.
So if buybacks are off the table, what's the focus for that cash?
M&A, mergers and acquisitions. They explicitly said they want enough cash on hand for potential deals.
Makes sense. Any mention of dividends?
Dividends are still an option, they said, but they also reminded everyone there's a 20% Israeli tax implication on dividends paid out. So another factor to weigh in how they use their capital.
Okay, so bringing it back to the core strategy. Despite all this financial pressure, the lower guidance, the market weakness, they're sticking with their people.
Yeah, absolutely no layoffs, even though non-GAAP operating profit has basically been cut in half from around $45 million down to $21 million per quarter. They call themselves a people-intensive company.
And they believe this hurts now, but pays off later.
That's the bet. They said it positioned them for a stronger rebound when or if the market turns around. They also admitted they got burned in 2024, predicting a recovery that just didn't happen.
Yeah, that must have been tough. It really makes you wonder, though. If you're sitting there seeing those profit numbers drop, do you stick with the long game or do you make the cuts?
It's a massive test of conviction, isn't it?
Absolutely. So I guess the big question for anyone watching InMode is, what does this bold decision mean? Sticking with investment in people and R&D, avoiding those short-term cuts, is this setting them up for a really powerful rebound when things eventually stabilize?
Or is it a risky gamble? Could it just weigh down their profitability for, longer than they anticipate if the market stays sluggish?
Yeah, how do you, as an observer, weigh that management conviction against these pretty harsh, immediate financial headwinds?
That really is the central dilemma, isn't it? And, thinking about that tension, especially the geographic divergence, it leads us into an interesting thought for our This Is Not Financial Advice segment today.
Ah, yes, the trade idea. What have you got?
Well, given how clear and strong that split is, Europe doing surprisingly well, record sales even, while the U.S. is really weak. It does raise a fascinating question, right?
Okay.
Does this divergence maybe set up a potential paired trade scenario? Or at least a way to think about the relative strengths differently.
Interesting. Go on.
You could, hypothetically, explore a strategy. Maybe consider shorting a basket of companies that are really heavily reliant on the U.S. elective aesthetic market. The ones feeling that consumer and capital spending pinch the most.
Okay, short the U.S.-focused players.
And then simultaneously, perhaps go long on a selection of European medical aesthetic companies. Assuming, of course, that InMode's experience isn't totally unique, that it signals broader regional health differences.
So leveraging Europe's relative strength, maybe driven by different economic factors or even management changes they mentioned, contributing there as a hedge against that ongoing U.S. weakness.
Exactly. It's definitely an outrageous thought, playing the regional divergence like that. But based on the stark contrast in InMode's numbers this quarter, maybe not entirely implausible to consider analyzing the markets that way.
Certainly food for thought.
But of course, remember everyone, this discussion is purely for informational purposes. It is absolutely not financial advice.
Always do your own research and due diligence. Well, thank you for tuning into this depth dive from TalkTickers. We'd love to hear your thoughts on InMode's call and what you're seeing out there in the market.